Hey everybody, hope everyone's doing well. This is the overview of the Emini 5-minute chart for Tuesday, September 17th, 2024. So if we think about the daily chart coming into the day, we have this rally, we have 6 consecutive bull bars, good for the bulls, but the context is bad for the bulls. Big outside up day, and there was good momentum. We saw on the 5-minute chart, really strong rally, follow through, more follow through, but the bodies are getting smaller and smaller. So the momentum is drying up, and the market is testing the highs of this trading range. So we had a rally, expanding triangle, the bulls hoping it's a bull flag. We got a bear breakout, but 50% pullback of the rally. So the market tests 50%, and we find support and rally. But the problem is, as we get closer to these highs, we have bulls who bought up here, and they sat through this drawdown, and maybe they scaled in. But what do you think a bull's going to do if the market tests back up here? We're at the top of this trading range. We're at the top of the bigger trading range. So the odds are there are sellers above and disappointed bulls looking to exit not far above where we are. So I thought the upside today would be limited. Plus, yesterday was an inside bar on the daily chart, and that increased the chances that there would be sellers above and buyers below. Inside bars are trading range bars on trading ranges on smaller time frames. So let me see. The high of this range, 57.30 and a quarter. Okay, 57.31. I'm just going to put that on this chart. And I'll just label that daily chart trading range high. Okay, so coming into the day, the market gapped up, and we had a bear reversal bar on bar 1. So gap up, that's good for the bulls. Trap traders below, probably going to get a second leg up. And if you compare the gap up to, well, first of all, let's look at the Globex chart. Let's take a look at what we had coming into the day. So back here, here's the close of yesterday, and the market sold off for a couple of legs and then rallied. But up here it became more two-sided. We had a deep pullback here, bears selling above, making money, selling above, making money. So the market, we had a spike in channel, bull trend. The odds were the channel would convert into a trading range. We'd probably test down here. So the upside might be limited, bulls taking profits above and bears selling above. So even though the market rallied, we know that we're in the channel phase. So we sold off for a couple of legs on the open. 1, pullback, 2. Bars 4 and 5, strong enough down for a second leg down. Inside bar on 6, it's a pause bar. probably sellers above for a second leg down. The bulls may be looking for 1, 2, 3 pushes down to test the moving average, maybe get a higher low after the gap up and look to buy for the second leg up. Then we got bar 7. 7, a little bit of a surprise bar. Bar 6 was an inside bar and it closed below its midpoint. So not a very good stop order buy signal bar, but it got a good entry bar and then follow through. Now you can see bar 8, we tested the daily trading range high that I marked over here. We're expecting that to be resistance. And now at this point we have a gap up, which is one leg, two-legged pullback, and then another rally from bar 5 up to bar 8. Now this rally is strong enough for its own second leg, buyers below, and will probably get above the high of bar 8. But we may pull back first. This is a little climactic, and after this spike and pullback, at this point the market is maybe channeling up. So at this point we don't know if the market's reversing or if this is a minor reversal, although we know it looks like a minor reversal after the gap up, 2 legs down, continuation, but now bulls will take profits at new highs and look to buy lower. So we went sideways on 9 and 10, bad follow through for the bulls. High one buy, 11, but disappointing follow through on 9. Now we have 4 bars overlapping each other. High one, but 2 legs up at the top of a higher time frame trading range, probably sellers above. 12, now we have a second entry short. We sold off. We fell below bar 10, reversed up. Now we have a micro double top on bar 12. So always in bulls, maybe they get out below 12. Bears, maybe they short. 13, good entry bar, but still probably buyers not far below. And then we reversed on 14. So what happened? Market tested 50% of this rally, found buyers, and will probably get above the high of the day. But if we do, then it may be 1, 2, 3 pushes up, and there's probably sellers up here. So you can call bar 13 a high too, maybe double bottom with 9 and 14. But the bar is fairly big, and just like over here on bar 11, if you're buying this high too, you're buying at the top of a trading range. It's not very clear on this chart. It's good to know the higher time frame context. But even on this chart, if you're buying a high too, and you're buying near the high of the day, your premise is that the market is in a bull trend, because that's okay to do when the market's in a bull trend. However, over here, if a bear sold above bar 1 and scaled in higher, they made money. And if a bear sold below 12, they made money. So if a stop order bear is making money, the market is probably not in a bull trend. And if it is, it's not a very strong bull trend. Probably sellers above, but they may come in a little bit higher. 15, the entry bar for the bulls is, at least it was a bull bar, but not very good. 16, a trend bar. But there are a couple of problems for the bulls at this point. 14, a big bar, 15, small bar, and then 16, another big bar. So a bull, for the bulls, it's 1, pause, 2 legs up, and then it's also 1, 2, 3 pushes up. And we're trying to break out of the daily trading range high. And does this look like a strong breakout of that trading range high? No, of course not. 16 is breaking out. It's breaking out above prior bars. That's good for the bulls. But they still need follow through. So they need one more bar, and then they don't get it on 17. So at this point, 3 pushes up, and then a bear bar closing on its low. At a minimum, we're expecting 10 bars and 2 legs going sideways to down. After the 3 pushes up, here's a deep pullback, 50% and even more. So bulls, always in bulls, probably exit below 17. And aggressive, always in bears, they can short. Now 18, a big trend bar, but buyers into the close. But this was a significant bar because if you think about major higher lows and higher highs at this point, so the market gaps up, here's a high, higher high, higher high, low, higher low, higher low. So this is a major higher low. The market rallied to a new high and closed up there well above the prior highs. This makes this a major higher low. When 18 falls below that major higher low, the argument that the market is in a bull trend is no longer in effect. So while I said always in bulls get out below 17, in theory their stop is below 14, because if the market falls there, it's no longer a bull trend. So always in bulls stopped out on 18. That means the market is at this point either in a trading range or a bear trend. Consecutive bear bars, one being big, one closing on its low, might be always in short. This is strong enough for a second leg. It's possible. It's an expanding triangle bull flag. We rallied 1, 2, 3. But the reality is the context where we're trying to break out from, this looks too weak, and the bulls are probably going to wait for lower prices to buy, and 17-18 needs a second leg down. Plus we're expecting 10 bars and 2 legs after this anyway. So we went sideways to up, pulling back after this bear breakout, but the odds are sellers above. We rally above 19 and find sellers. Now we have a double bottom, 19 and 23, but a bear body, so it's a weak signal bar, micro double bottom, but high in a trading range. Probably sellers above, and then bears sell the close. Now traders would sell the close, or traders would sell above this bar, but at some point when their orders are not being filled, there's a sense of urgency, and they just end up selling the market and chasing the market down. So 24, it's a credible stop order sell, because the market may be always in short from 17-18. The bottom of the range could be the bar 5 low, or it could be all the way down here. And you have a possible always in flip, a pullback, and then double top and a bear bar closing on its low. Small entry bar, but no bull bar, so bears can stay short, always in short. And by the way, when I say always in short, it's really not clear. This looks like a trading range, and in trading ranges, it's usually better to count legs and look to buy low and sell high. So always in is not the greatest strategy when the market looks like this. Always in is for trends and swing trading. But if I had to put an always in direction in the market, I would say this was strong enough to flip the always in. And you can see we retested the breakout point during 19, found sellers, tried again, found sellers. So this breakout will probably get at least one tick below bar 18. And we are continuing to drift sideways to down. It's becoming a tight bear channel, but it may be 1 pullback, 2. Now I still think we're going down here, but if we get 2 or 3 legs down, low in the range, bulls may start to buy. So remember, we gapped up and we had follow through buying for 3 pushes. The bulls are hoping this is a minor pullback, and always in bulls are looking for a credible buy setup. So a bull bar closing near its high, maybe a double bottom with 18 or even bar 5. But where do the bulls get that? Maybe they buy above 30, but then they exit below 31. And is the market clearly always in long here? I don't think so. It's also not clearly always in short, but the bears do have a couple of open gaps. There's a gap between these bull bodies. There's a gap between these bull bodies. And that's sort of it's a subtle warning that the bears are strong. On a line chart that plots the closes of bars, there are open gaps. And so even though this looks like a bear leg in a trading range, when you have open gaps, you have to be open to the idea that this may turn into a small pullback bear trend. We're going lower, bar 18. We broke below it. The bulls are hoping for a double bottom with 18. They don't get it. So now we have a possible measured move projection down to here. The bulls were hoping for a double bottom, and then here's the neckline and measured move up, but instead we broke straight through it. Now, at this point, bar 34, think about a bull who bought the low of bar 5. arguing the market is in a trading range and you can buy low. So if you bought on a limit order, 34 is your entry bar. Are you excited as a bull? No, of course not. If you bought the low, the market closed below your entry price. And if you're a limit order bull, you want an entry bar like bar 14. You want the market to hit your limit order, reverse up strongly. And that did not happen. So bulls who bought here, they may just exit. We're getting a lot of bear bars, tight bear channel, and then a bad entry bar for the limit order buy. So 34, a trend bar, it's either exhaustion or a measuring gap. Maybe we're getting near the bear channel line, but there's still some room to it. And if you think about day structure, the range at this point is small. The average range may be about 50 points right now. And at this point, the opening range, if you use up to bar 16, was only 26 points. So we could double that range today. And so maybe if you're less aggressive, you start with maybe bar 9 and go to bar 5. And the bears are looking at that measured move down, measured move of the opening range. And this may be a measuring gap. And if it is, the bears will project it down like this, either to here or to here. So targets below for the bears, not a lot of buying pressure, probably going lower and then follow through 35. So it may be exhaustion again. We're testing the high of yesterday. We're bouncing there, but is there any reason to buy right now? I don't think so. I think it's more clearly always in short at this point, and we're probably going at least a little bit lower. Another target for the bears may be a measured move of the breakout and follow through, 34, 35. That takes us here. Pulling back 36. Is 36 strong enough to reverse this? Probably not. Usually, when you have a breakout and you're expecting it to get a second leg, there's a high probability this gets a second leg, and we go at least one tick below the low of 35. So normally, when you get a bar like 36, it's a strong-looking bull bar, but the context for it is bad. It's probably a minor reversal, and bars like these, you can sell above, you can sell the close, stop up here. High probability you make money. Consecutive inside bars, II pattern. The bears see trend resumption. The bulls are hoping for trend reversal, but the second bar of the II pattern is a bear bar. And if you're buying an II pattern, you want the context to be better than this. First of all, it's better if it's maybe at the bottom of a trading range and not directly following a bear spike. And you also want the second consecutive inside bar that you're buying above to be a bull bar. So the bulls don't have much going for them. Bears, they have a low one short below 37 and a strong bear breakout, probably going lower. And then 40, 39, 40, it's another possible measuring gap or exhaustion, but we have a sell climax here, sell climax, consecutive sell climaxes. Now the problem, bar 40 is going to attract profit taking from the bears. Why is that? Because the stop for the bears may be up here. Maybe it's above 36. And if you're selling here, remember, it doesn't matter if you sold the high tick of the day or the low tick or, sell the close of 40. It's the same trade. So your stop is here, and open profit does not mean you have no risk on the trade. Open profit is risk, and the risk of your trade is the market price to the price that your stop is at. So if this is your stop, you're selling here. 1-to-1 is all the way down here. And if the momentum starts to fade, and this is just consecutive sell climaxes, we could easily pull back. We could test the moving average. We had a lot of trading range price action here, so we may just be getting a sell-off that eventually converts into a trading range. We have a bear breakout, implied pullback 36, and then more follow through down to 40. But this is an important area because this is where the channel phase began. There's no technical pullback. Maybe there is here above the inside bar. But in any case, the market paused and then continued. but this is a sell climax. It's not sustainable. We're moving further from the moving average. The moving average can't keep up, so we're far below the average price. And if you're selling down here, you need the momentum to be sustained. And if that momentum disappears, you need to exit the trade. Your premise is no longer valid. If you're selling down here as a bear, you're not selling value. So that's the problem for the bears here. The trader's equation, 1-to-1, it's not 60% that we're going here, especially after you see bar 41. So bears, they may just exit above 41 and look to sell higher. Still always in short, but there's a real risk that we can rally and test breakout points like the 35 low or the moving average, or maybe yesterday's high. Low one short 43, but lots of overlap. It's an inside bar, and it's consecutive sell climaxes. Low ones are better when they're early in the move, like up here, possible measuring gap. And the signal bar is at least a bigger bear body. This is more late, consecutive sell climaxes, and then a lot of overlap. The rally from 41, the low of 41 to the high of 42, that was enough damage done by the bulls that any continuation should lead to buyers below and a deeper pullback. If you're a bear and you sold below 40, you're disappointed with your entry bar, and the market rallied even further away. So if you can get out somewhere near your entry price, you'll take that and then look to sell higher. So buyers below the inside bar, it's another bull bar. Second reversal for the bulls, reverse above 41, continuation, and then a reversal if we go above 44, and we did on 45. So always in bears, they might be out here or here, and we may have to go higher to find sellers. Can the bulls buy? Maybe the bulls buy for a scalp, but it's really not ideal. Counter trend like this. This is looking like a minor reversal, so probably better to look to sell. The bulls get 3 consecutive bars, and then we have a give up bar, 47. The problem with 47, there's a couple of things. So the context, tight bear channel, then the rally from 41 to 42, leg 1, pullback, leg 2. So we have a second leg, and I mentioned over here this is the start of the channel phase, and it would probably be the top of a trading range. And we might be getting high in that trading range. We're testing the moving average, and it's parabolic. The trend line for the bulls is getting steeper. And so this is more likely a buy vacuum testing resistance. We're testing that breakout point, the 35 low. If a bull bought here, they're trapped. What's a bull going to do if we get back to this red line? Limit order bulls who bought scaling lower, they're going to look to get out. So we vacuum up, but probably sellers in this area. 48, you can call it a low 1. You can also call it a low 2, where the low 1 was 43, and this is the low 2. It's a big low 1, low 2. But this all may be one leg, and we may get a deep pullback and then a delayed second leg. It's really common in trading ranges to get delayed second legs. I want to see if I can find a good example. Let me see. This is a good example. Let me see. Let's go back a little further. This is okay for an example. So the market rallied, and this is a tight bull channel, parabolic wedge, 1, 2, 3. So you expect a pullback, but this entire rally might just be one leg and one breakout on a higher time frame. It should get a second leg. Even if we pull back, we should get one tick above the high. We start to pull back, and all of a sudden we have an endless pullback. Now, this breakout by the bears is strong enough for its own second leg, but it can get a deep pullback. Maybe we test breakout points. Market rallies for 2 or 3 legs sideways. The bears get their second leg, and then finally the bulls get their second leg. So 1, pullback, 2. That's kind of what I mean by delayed second leg. And so that's what I'm thinking here. The market rallied for a couple of legs. This may be one leg, and if it's a trading range, what's common, even if this is strong enough for a second leg, buyers below, the buyers may not come in until below 45 or 41. Also, one more thing I thought was significant, and I don't know if I touched on this yesterday, so one more brief thing about yesterday. The bears had this sell-off, and the odds were they would get a second leg, and it would get below the low tick of the first leg. We had a low 1, the bears tried for a resumption, failed, but this may just be a pullback of the pullback. And what I mean by that, bear breakout, pullback, but strong enough bars in the pullback for their own second leg, so a pullback of the pullback, then the pullback leg continues. 1, pullback, 2. So is this leg 1, leg 2 for the bears? It might be, but markets like symmetry, and the odds are the bears will get a better second leg than this. But then the market went sideways for many bars. They tried to resume down here, and they failed. Now we have a higher low. They tried again here, failed, higher low from here. And this was really significant. Bull breakout 36. This may have flipped the market to always in long. This may have been a give-up bar. The bears who sold down here or sold anywhere looking for resumption, the bears tried 1, 2, 3 times, and they could not get down here, and they gave up. And now we have a stop order buy here that never got retested, open gap. That's a significant price, and that will be support because traders got trapped. Bulls who did not buy here, trapped out of a good trade. Bears who sold here, trapped into a losing trade. You can see bears tried to get out here but could not, and then we rallied for a lot of bars. And I bring that up because it was significant today. So this lower red line is that stop order 35 yesterday. Now we're going outside down 49. Okay to sell. Bears might sell below 48 or 49. Still always in short, but deep enough pullback. The market's either in a broad bear channel or it may be converting into a trading range. And then we sold off to a new low, and look where the market tested. Straight to that stop order entry price, and then we reversed. Now, we already know, even if we didn't know about that stop order trade, we know that the market cycle, we get a spike, pullback, and channel. And in the channel phase, for the bears take profits below bars and they sell rallies. So, strong sell-off. The odds are this is minor. The first reversal up should fail. Bears will sell a rally like this to the moving average. But this was enough damage that the bears will take profits at new lows and the bulls will buy for a delayed second leg. 1, deep pullback, 2. So that's what I mean by delayed second legs. So now up here, if you're buying up here, you may be buying a second leg, 1, 2, high in a trading range. We're still mostly below the moving average. This was a decent sell-off, and it looks like we found resistance at the bar 35 low. And even if we go a little higher, still probably resistance at yesterday's high. At this point, it looks like today will be a bear trading range day. Trading range on the open, bear breakout, and then trading range into the close. The bears are hoping we get a second leg, 1, pullback, 2. But this was enough to disappoint the bears, kind of like yesterday. Big sell-off should get a second leg, but then the bulls did enough damage sideways to convert the market into a trading range. And then the breakout direction becomes 50-50. So we rallied a little higher, 1, pullback, 2, and 1, pullback, 2. So nested 2 legs, high in a range. Bulls will take profits, bears will sell. 57, a decent bar, but strong enough and tight enough rally that there's probably buyers below for a second leg. Moving sideways to down, maybe an expanding triangle, 1, 2, 3, 1, 2. Bulls hoping it's an expanding triangle, bull flag, and we break to the upside. Bears hoping for the opposite. It's high in a trading range, probably sellers above, maybe a high 2 above 61, but doji and top of a range, not ideal. And then a sell vacuum on 64. Buyers into the close, we're testing the low close of 51, low in the range. Any bear who sold up here is taking profits on 64. 64 may get a second leg down, but it also may get a deep pullback first, and the second leg could be delayed. This breakout for the bulls should get a second leg as well, and this may be the deep pullback that it gets, and then bulls come in and buy here. Small pullback, maybe this goes a little bit lower, but now we have a low one, and it's fairly low in the range, and we may find buyers below. Low ones are good over here when the market's breaking out, and it's early in the market cycle in the breakout phase. Over here, we're in the middle or lower third of a tight trading range. So a low one short, after you've had a couple of legs down, it's probably buyers below. We've rallied to the moving average, we're stalling and going sideways. We're in the middle of a tight trading range, getting a lot of overlapping bars. It's a limit order market, and again over here for always in, it's really not ideal. I should have mentioned over here, I did mention that bears might get out here, maybe they sell again here, but once they get 52, bears are getting out. And the market's clearly, big down, big up, big down, big up. The market's sideways and always in. Does not work so well. The bears, they got their second leg, and then we reversed up, and we ended up rallying back to the top of the range at the end of the day. Stop order trades today. I thought it was reasonable to buy above 7, maybe buy the close 8, disappointed, 9, maybe you scalp out, look to buy lower, maybe you buy above 14, but again, not ideal because 1, 2, 3. I thought 17 was a credible sell, 24, reasonable to sell below. At this point, if you're thinking always in short, you can sell below any bar, closing below its midpoint, and just exit above a bull bar. And if you use that logic, maybe you exit here, sell again here, and then you don't get out until all the way down here. Still always in short, not a credible stop order buy, 41, but a second reversal is better for a scalp for the bulls. But it's a counter trend scalp, and the bulls know if they're buying here, they're not expecting a huge rally. They're expecting a minor reversal and a test of a breakout point and the moving average. Stop order below 48 was reasonable, even though it's against 3 bars, getting stronger in size, and it's a decent rally that should get a second leg. Because of where we are in the market cycle, we have a breakout, a pullback, we're in the channel phase, bears are selling rallies, and even though this should get a second leg up, the buyers won't come in until low. So you can sell here and get out lower. Okay to buy above 52, but 53, even though it's a bull trend bar, it's a fairly disappointing entry bar. It's much smaller. This bar is 15 points. This bar is 8 points. This is about half the size of this bar, and that's a loss of momentum. So maybe you buy, but scalp out, disappointed. You're at the top of the range. You needed it to break out, and it didn't. Bears, maybe they sell below 57. It's a high 2, nested high 2, low 1. Low 2, low 1, 48. Low 2, 57, and then low 1, 54, low 2, 57. Maybe you sell here, but trading range, you scalp out at the lows. And then maybe, not an ideal buy above 65, but it's a micro double bottom and a double bottom over here. But tight trading range, stop orders, not ideal. And so where do we go tomorrow? We tested the top of this range and found sellers, and we have this rally, and the reality is there's probably buyers below. This is not a great stop order sell, but the market's in a trading range, and even though this should get a second leg up, the bears may get a second leg down, and it just may be delayed. So maybe we get a bear breakout, deep pullback, and then a second leg. Maybe the bulls get a breakout, deep pullback, and then a second leg. Just like this was a bad stop order sell, but it succeeded to go lower, the same thing could happen here. But we're in an area where the market found the price to be fair. We went sideways for a lot of bars here. We may start to go sideways again here. Overall, I think the upside is limited. I think we're high in a trading range here and over here, even if we rally a little more. I'm expecting more sideways tomorrow. Sellers above the high, buyers below the low. But the buyers may not come in until this low or this low. or maybe way down. We don't know. All right, thanks everybody for watching. Hope everyone has a good night.